And the last chart I wanted to pull was a retracement chart. So you take a Fibonacci retracement, which is sequences that are commonly seen from highs to lows on where the orders get filled back in. That's a 38.2%, 61.8, and of course the 50% retracement,
right,
which happened last week at 4220 on the S&P 500. And believe it or not, there's never been a bear market, so peak to trough of more than 20% drawdown, that filled 50% back up and went back down to test new lows and break below those lows.
Right. So
it's always gone on to new highs in the cycle.
So if you covered that 50% retracement, you're always going to make new highs historically. You're never going to go back down and test new lows until you've hit that new high.
Right, and that doesn't mean the market goes straight up after
right.
that. It just means it hasn't historically broken back the low that was put in, and that's shown in this chart. This pulls the last 15 times that this happened. And to the right, where we're looking at the 1 month, 3 month, 6 month return after the 50% retracement was in, the 1 month median return is actually negative. So it's not saying we're just going to go off to new highs. There could be some downside, and there's plenty of periods in the 3 and 6 month that are negative. But in the long run, we have not seen a 50% retracement go back and make new lows for the cycle.
So if we were to stop this call right now, based on technicals, which have historically been accurate, and it could always change, it would say, hey, we're going to go to new highs now. We've seen the rough. Yeah, there's going to be some trouble. We certainly can go down lower, but we're not going to get to those previous lows without making new highs. So then that would be bullish. But there's more to it than that, right?